Guys, welcome back to the channel. Today is the 7th of December 2016. I'm going to read a quick article by Alasdaır Macleod from goldmoney.com, and this was published on December the 1st, 2016. Titled Credit Cycles and Gold. The Trump shock produced some unexpected market reactions, partly explained by investors buying into a risk-on argument, equities over bonds and buying dollars by selling other currencies and gold. This is because President-elect Trump has stated he will implement infrastructure, investment and tax cut policies. If he pursues this plan, it will lead to larger fiscal deficits and higher interest rates. The global aspect of the market's recalibration focuses on strains between the dollar on one side and the euro and the yen on the other, both still mirrored in negative interest rates. The capital flows obviously favour the dollar and are putting the euro currency markets under considerable strain. Gold has been caught in the crossfire, being a simple way for US-based hedge funds to buy into a rising dollar by selling gold short. While this pressure may persist, particularly if the euro weakens further ahead of the Italian referendum, which, guys, as we know, has already gone ahead and happened, and the outcome of that is the no, which has then had an adverse effect on the euro currency falling further. It is essentially a temporary market effect. This article explains why this is so by analysing the next phase of the credit cycle and the implications of interest rates and prices, which will be fueled by higher US fiscal deficits in addition to China's stockpiling of raw materials. It concludes that there are factors at work which are originally identified by Gordon Pepper, who was acknowledged as having the finest analytical mind in the UK gilt market in the 1960s and 1970s. Pepper observed that banks were consistently bad investors in short maturity gilts, almost always losing. The reason, he explained, was banks bought gilts when they were adverse to lending and sold them when they became more confident. This meant banks bought government bonds when economic confidence was at its all-time low. Bad debts in the private sector had risen and interest rates had fallen to reflect the recessionary environment. These were the conditions that marked the high tide in the bond prices. As surely as day follows night, recovery followed recession. As trading conditions improved, corporate takeovers become common as businesses reposition themselves for better trading prospects, and a period of increasing industrial investment followed. The banks began belatedly to sell down their gilt positions to provide capital for economic expansion. By the time banks felt confident enough to lend, markets had already anticipated higher demand for credit, as well as more inflationary outlook. Inevitably, banks ended up selling their gilts at a loss. Pepper had identified the mechanics behind bank credit flows between financial and non-financial sectors, an important topic broadly overlooked even today. Currently, the credit cycle has become prolonged and distorted because most of the accumulated malinvestments that would normally be eliminated in the downturn phase of credit cycle have been allowed to persist. Thanks to the Fed's aggressive suppression of interest rates, consequently, bank credit was never relocated from unproductive to more productive use, but has been added to and extended in the name of financial engineering. Things are about to change. President-elect Donald Trump has stated that he will expand government spending on infrastructure and at the same time cut credits, in which case he will set in motion a new expansionary phase for the US economy, leading to an additional increase in bank credit. The immediate effect has been to drive up bond yields and increase expectations of higher dollar interest rates. Working from Gordon Pepper's thesis, the banks only in their initial stages of mark-to-market bond losses, since they have yet to sell down their bonds holdings to create lending room for infrastructure expansion and a sharply higher fiscal deficit. That will not happen before next year, assuming Trump follows through on his economic plans. But markets can be expected to increasingly discount future bond sales by the banks and other financial intermediaries before then. And given that yields fell to unusually low levels ahead of Trump's expansionary plans, bond losses can be expected to be correspondingly greater. And obviously something that has occurred in the last couple of days is actually Henry Kissinger has had a meeting with Donald Trump, who, as we all are aware of, is a huge geopolitical player, even though he has no affiliated position inside of the US government, yet is one of the main puppet masters pulling strings behind the curtain, along with obviously George Soros, and has come out stating that Trump will not be following through on all of the steps that he is aiming to achieve in the first 100 days. We're already aware that he is appointing many NWO banking elites into the cabinet, and everyone is pretty much split in two views, whether Trump is actually a legitimate candidate, president-elect, that is going to create change for the people, and then there's the other side who are taking all this information as he's bought and paid for and sold to the New World Order. And no matter what he is saying now, none of this will be implemented come January. And it really is looking like nothing will actually change. That's just my perception, because I don't believe anyone can even get into the position of running for presidency without being connected through the establishments, because it's a bloodline right. And all you have to do is look at the history of who has been the previous presidents and how they are all connected by blood. Hence, you are never elected, you're always selected. So carrying on. The new expansionary phase, President-elect Trump is in effect advocating a substantial fiscal stimulus to the economy. The difference between monetary stimulus and fiscal stimulus is found in price inflation. Simply put, monetary stimulus tends to inflate asset prices, while fiscal stimulus tends to inflate consumer prices. Therefore, fiscal stimulus leads to the greater certainty to rise in interest rates and bond yields, because the price inflation effect inflicting painful losses for bank investors in bonds. The change from monetary and fiscal stimulus can be expected to undermine asset prices for reasons that will become clear. The following table illustrates the flows that can arise from fiscal stimulus of the economy and puts Pepper's thesis in a clearer light. And obviously, guys, that's coming up on your screen now. Theoretical financial allocation in expansionary phase of credit cycle, percent of total. Government starts at 35%, ends at 37%. Financial sector starts at 30, ends at 25. Non-financial sector, 35, finishes at 38, with a total of 100% readings. Governmental spending increase over the cycle, reflecting fiscal stimulus in this example from 35% to 37% of the economy. And because the fiscal stimulus is spent in a non-financial private sector, that increases as well. Inevitably, the financial sector, representing money that's employed in purely financial activities, gets squeezed, in this case falling from 30% to 25% of the economy. Financial activities can be said to deflate. While actual numbers will differ from this theoretical example, it illustrates that in the expansionary phase, money must leave purely financial activities. You cannot have both fiscal stimulus and a relocation of economic resources into the non-financial private sector without creating a powerful deflationary effect on financial assets. Consequently, not only will bond yields rise, but equity markets will be impacted as well. At the very point where fundamentals for equities appear to be at their best, today's equity market euphoria is therefore a reflection of improved sentiment ahead of the reality. Keynesians would argue that the strains faced by the financial sector can offset by credit expansion. Initially, this may be the case, so long as banks have room on their balance sheets for additional credit growth. However, the inflationary effects of fiscal expansion on consumer prices becomes a considerable and relatively immediate force, rapidly dominating monetary policy considerations. This is due to the fiscal deficit being directly translated into increased demand for goods and services through government spending, driving up prices as the extra money created out of thin air is spent. This result is interest rates are inevitably raised by the central bank to protect the purchasing power of the currency. Probably the clearest example in living memory of this effect was the UK economy in the first half of the 1970s, which prompted Pepper's analysis. From 1970 onward, the health government reflected aggressively by depressing interest rates and increasing fiscal stimulus. The result was a stock market boom that ended in May 1972. Gilt yields having bottomed earlier that year. As the economy improved, gilt yields rose further and equities entered a deep bear market. The Bank of England increased interest rates, while gilt yields rose, equity prices fell, and the price inflation increased. Speculation migrated from equity markets into commercial property, where rents and capital values responded to expanding office demand, driven by the artificial economic boom. Eventually, price inflation accelerated to the point where interest rates had been raised further, triggering a collapse in the commercial property market, necessitating the rescue of the lending banks associated with it. Over the course of the cycle, the Bank of England's base rate had increased from 5% in September 1971 to 13% in November 1973, precipitating the commercial property crash. Long-dated gilt yields had more than doubled to over 15%, and the equity market lost 75% of its value by the end of 1975. The British government's financial position was so bad, she had to borrow money from the IMF. All the signs of a similar cycle are emerging today, but on a grander scale, with Donald Trump intending to pursue the expansionary fiscal policies of Edward Heath. But there are obviously differences, particularly the high burden of debt in the private sector. In the 1970s, private sector debt levels were low, so much so that residential property prices in the UK were broadly unaffected by rising interest rates. Today, residential property prices at the margin typically reflect 80% loan-to-value mortgages. Indeed, the level of private sector debt in America is now so great that a rise in the Fed funds rates to between 2 and 3% may be enough to crash both residential property prices and the US financial sector with it. Another important difference is the interconnectedness of markets. Rising yields for US Treasuries are certain to transmit into rising yields in other currencies, particularly for the Eurozone. The Eurozone's banks, whose currencies' very survival could be threatened by the developments, will face bond losses potentially so great that the whole European banking system could collapse. The ECB is likely to continue to pump money into the financial sector in a desperate attempt to save the banks. But it can only do so much before the price inflation effect of a failing euro forces it to raise interest rates as well. Britain, along with everyone else in the 70s, as well as the US in the coming years, also had a specific problem in common: rising commodity and energy prices. Artificial demand generated by fiscal expansion in the US in the 1970s and 74 era contributed to a significant increase in the general level of commodity prices, most notably with the increase in the price of oil, as OPEC ramped it up from $3 to $2 per barrel in 1973 alone. And obviously, guys, that's a 400% increase. Rising commodity prices were paid for by monetary expansion, just like today. And today, China is pursuing vast infrastructure plans for all of Asia, which requires her to stockpile and use unprecedented quantities of industrial raw materials and energy. Trump's expansionary plans will clash with China's far larger plans, driving up commodity prices measured in dollars even further. This is in addition to the substantial gains seen so far, making a bad price outlook even worse. The chart on your screen now shows how the gold price behaved in the 1970s. Gold rose from $35 to $197.5 between 1970 and the end of 1974, an increase of more than 4 times. During that period, as mentioned above, the Bank of England's base rate rose from 5% to 13%. The Fed's discount rate was 4.5% in 1972 and rose to 8% in August of 74. So a rising gold price was accompanied by a rising interest rate, contradicting conventional wisdom of today. Gold went on to hit a peak price of $850 at the afternoon fix of the 21st of January 1980, when the Fed's discount rate was at an elevated 12%. The current belief that rising interest rates are bad for gold was disapproved by those events. The reason gold rose had little to do with interest rates, and everything to do with accelerating price inflation. The only way a rising gold price could be halted was to raise interest rates high enough and sharply enough to collapse economic activity, which is what Paul Volcker did in 1980 and 81. In other words, until the Fed abandons all pretensions to supporting economic growth, people will continue to increase their preferences for owning goods over holding dollars, thereby continually reducing its purchasing power. Another way of looking at the prospective gold price is to think of it in terms of raw material prices, which tend in the long run to be more stable when measured in gold than when measured in fiat currencies. Given the outlook for commodity prices, as both China and America compete for raw materials and expand the quantity of money to pay for them, the gold price is more likely to maintain a level of purchasing power against rising commodity prices. Instead of it declining with paper currencies, China has prepared herself for this event, having embarked on a long-standing policy of stockpiling gold since 1983. The amount she has accumulated in addition to declared reserves is a state secret, but my estimate is at least 20,000 tons. And guys, that is extremely low and conservative, so you'll be better off ballparking it around the 30,000 tons and growing, because there's a lot of undeclared stockpiles that China mines itself, but for the purposes of this article we'll just carry on. In 2002, the state had presumably secured enough physical gold for itself to allow its own citizens to join in, because that is the year the People's Banks established the Shanghai Gold Exchange, and the ban on private ownership of gold in China was lifted. Over the last 14 years, private individuals and businesses in China have accumulated at least another 10,000 tons, and China has become the largest producer and refiner of gold by far. We can truly say that China has prepared herself and her citizens well in advance for the collapse in purchasing power of the paper currencies that her demand for commodities is likely to engender. The only thing she must do is to get rid of her accumulation of US treasuries before they become worthless, which she is doing now. America, by contrast, is wholly unprepared for higher commodity prices. Her gold reserves, assuming they are as stated, and following on from my last video, guys, the Fort Knox holding is supposedly 8,100 tons, which obviously has been loaned, leased and sold and will no longer be there, carrying on, are insufficient to underwrite a decline in dollar, and in any event, conversion into gold is not on offer to holders of dollars. In terms of commodity demand, America will be playing second fiddle to China in the coming years anyway, only making a bad price situation potentially worse. Because of continuing non-cyclical Chinese demand for commodities, there is significant risk that not even a debt liquidating slump brought about by significantly higher interest rates would kill price inflation in Western currencies. Unlike the 1970s, when the dollar was the tune to which all others danced, China, Russia and all nations tied to them by trade no longer dance exclusively to the dollar's tune. Consequently, US monetary policy no longer exercises absolute control over global price inflation, measured in fiat currencies. Price inflation pressures could therefore persist despite a US debt liquidating slump. The possibility that the price environment for the dollar will continue to be inflationary in a US economic slump, despite the Fed's monetary policy, cannot be ruled out. But before that possibility is put to the test, the likelihood of a systemic collapse in the Eurozone is a more immediate and threatening risk. Conclusion: we currently face the prospect of a relocation of capital from America's financial sector into government and non-financial activities, driven by President-elect Trump's expansionary plans. These plans, if pursued, will lead to money flowing from purely financial activities and will have a profoundly negative effect on asset prices. Furthermore, price inflation, the result of fiscal expansion, will raise consumer prices to unanticipated levels, forcing the Fed to raise interest rates more than expected today. This article has pointed out why rising interest rates in the expansionary phase of the credit cycle do not undermine the gold price, unless and this is no longer certain, interest rates are raised to the point where the US economy is driven into a slump. However, the world is no longer dependent solely on the US economy and monetary factors, because Asian demand for industrial materials has become the principal engine of commodity demand. We can therefore no longer be sure a Volcker-style shock from the Fed will kill price inflation at the end of the upcoming expansionary credit cycle. As all experience from the past clearly demonstrates, it is a mistake to believe that gold price is set solely by dollar interest rates or its relative strength in other currencies. This being the case, the current weakness of the gold price is simply a reflection of temporary dollar shortages and nothing more. And I'll also add on the end of that, guys, you've also got the Shanghai Exchange, which is obviously buying real physical gold at a different rate to what is being transacted in the West. And as we know, that will be having a drip effect of draining all forms of gold from the West to the East because of the higher valuations. And when you're talking about huge mining operations, the cost of actually shipping a couple of tons of gold is very cheap via chartered flight. And the actual arbitrage price per the ton, if you sold it from West to East directly onto the Shanghai Exchange, is something like close to $1 million in difference. When you calculate it on 32,000 ounces, it's something like $1 million, which is obviously more than enough when you charter a flight, which might only cost you 100,000. So if you're in the big ballers game and you have roughly $35 million laying around, you could buy your gold subject to availability, but you could place your order on the COMEX, stand for delivery of that 1 ton, and ship it directly to China, making somewhere in the region of $900,000. And China will obviously buy that on the spot. But it's an interesting factor what will happen when all the gold from the West is drained to the East. Because if you think about it in terms of miners who are mining a few tons a year, why would they be selling it to the Western nations for the lower values when they can ship it direct to China or fly it direct to China, which increases obviously their bottom line as an operating business. And that's the thing about business, it's all about profit. So that is what's going to be happening to the gold. But I just wanted to share that for an additional add-on at the end. But it goes to show that if Trump follows through with his agendas that he's wanted to carry out, it's just going to increase the deficit of roughly 20 trillion that it currently stands at in the US. And all this is just like another artificial stimulus program, which doesn't actually fix anything. Sure, it takes the guy off the street who needs the job to pay for the food to feed his family. But in the long run, the only way to fix this epic cycle of debt is to collapse it, is to let it naturally reset. And people just have to go through the pain to create a better system on the other side. Because this kind of stuff is not sustainable. And the longer you leave it, the worse it will get, the longer it will take, and the more generations it will take to fix. Anyway guys, I'll leave it there. Thanks so much for watching. I'll see you on the next video.